So this program is the 1 month program initiative taken by our company Smart Finance to educate the stock market traders. And it is, as I told you earlier, it is being divided into two phases. First phase, you will be learning about the concepts involved in the trading, and second phase, you will be seeing those concepts implementation in the live market. So in this regard, our program has started from 7th of April, and today is the second week's last session. And this particular session, you will be learning about the delta neutral option strategy in the low and medium volatility condition, how to initiate that. And the third week, which is starting from coming Monday. So there are some complex strategies you will be uh, learning about the pair trade with option combo. Along with that, some investment plannings and other things you will be learning. So this is what you are going to learn in this particular event of 1 month. Then last week we have the live sessions scheduled for the week, and this is how we should will conclude this program. And I request all of you to visit the YouTube channel to see those video recordings, whatever the events we have conducted so far. No technical problem we have found, so we have uploaded most of the videos in the YouTube channel. You can visit our YouTube channel, you can just go to any of our web pages. If you just click on this YouTube link, then you can land in our YouTube channel, and there you start learning about our recorded events. Our recorded events you can learn from this particular YouTube channel. Also, as a webinarian, you will be getting uh, some conceptual understanding, but I will again advise you to visit the article link of our website, which is very much here, so that you can able to learn many concepts which is being given in the article form. And also you can download the weekly trend reports, whatever we are giving as per the one standard deviation. So every Friday we release this particular thing, and you can go through this report. Do share this concept of one standard deviation and this trend report with your friends, so that they too can take the benefit of this particular method. Do share these videos with your friends so that they can also learn some of these concepts, because the major problem in India we face that most of the traders are ill prepared. They do not have a conceptual understanding. They focus more on the future prediction, like a Jyotish, someone should predict the future of the market. Such kind of things they used to always aim for, and they used to fall in the prey of the people, those who just take that advantage and mint some money by the way of selling the calls, by the way of promising them a high return and other things. So for that reason only, I wish all of you to share this particular knowledge, so that the facts should be kept in front of them, that yes, market has a science. So to achieve the success in the trading, I need to learn, so that attitude should develop. For that reason only, I just want that you should take this thing as a social initiative to share with the people. Though through our 11 years of activities, we are doing many things to promote this cause. However, we alone cannot able to achieve this big mass of the traders. So this is an appeal from my end. Give back to the society of the traders whatever you have. If you have a good knowledge, good skill, and if you have a good concept which rewards the trader better, share it with the people, those who are in this trading fraternity. The major thing is that many people used to lose their hard-earned money in this trading. So this is a high time that those who learn specific concept, they must take this thing as a social initiative and share with the people, so that people should come to the market with a formulated knowledge. They should understand what is market, how I can trade, how I can invest. This concept should be clear to them before they enter the trade. And which concept works, what is the trend finding, how the trend finding works, all those things they should understand. Without the skill of that, always they used to fall in the prey of the people, those who used to sell the calls, those who used to give a false promise that yes, your money can double triple it with no time in the options. And many people also promise that yes, some point of some point in the earth, and some people know the special skill to tell that hey, yes, tomorrow where the market is going to open and where it is going to end. It is totally ridiculous and it is totally false. So it is a demand and supply scenario, and no one in this world knows that Monday where the market is going to open and where it is going to end. Just we can calculate the trend, and whenever that the trend is obliged by the market, followed by the market, or the demand and supply scenario is to accept that trend, that time only we can take action. But we cannot say well in advance 3 days before, 1 days before, that tomorrow where market is going to open and where it is going to end. So that is not at all possible. If someone is promising you for such kind of things, then it is a blunt lie, you can say. That is not known as a trend forecast. That is not known as a trend forecaster. Process of forming delta neutral option strategy in the low and medium volatile condition is the most simplest way I will discuss this particular concept. And this is a very small concept in the option strategy delta neutral approach, and it is most easiest concept. Whenever you look into the vega neutral or theta neutral approach, that involves a little bit of more in-depth study into that subject. However, if you wish to implement this delta neutral approach, it is quite easy approach. So that yesterday also I have given you the conceptual understanding about the delta neutral strategy in the high volatile market. I have also told you that your trade planning should have only one objective: to hedge your money, or to control, to protect your money first. So then the objective of achieving the success will definitely emerge from there. I have also told you in a high volatile scenario what are the volatility bands for high volatility, medium and low in the option context. And I have told you many strategies are present to take the benefit of this high volatile scenario, but I have told you only one single strategy yesterday, wherein I told you form a cross calendar bull or bear spread having the same delta. Means you should buy a call option of this month having X delta, and you simultaneously sell the call option of some different strike of the next month or the near month. So current month, in technical terms, this current month, near month and far month we used to say. So 3 months contract is known as current month, near month and far month. So yesterday I told you, if you are buying a current month contract in a high volatility scenario of strike say 8,000, then you must sell a call option of next month, which is near month, of a different strike, so at a price of Y, provided that this X and Y strike should have same delta, so that you can switch your net delta to 0. So that is one of the best strategy which you can implement in the high volatile scenario. So you look into the call option if the trend breakout given in the upside direction, look into the put option if the trend breakout given in the downside. I have told you how you can understand the put call ratio. Whenever the put call ratio goes above 1.16, it is a uptrend, and trend never used to return from that point. That also I have told you. And I have also told you that whenever there is a 0.75 below it maintains, then it can consider has to be a downtrend, and that downtrend, though it gives you a temporary relief rally and other things, however, that the trend, internal undercurrent of that trend used to be remain as down. So this, from a put call ratio, you can do a formulated understanding about the market, one general understanding about the market you can derive. That is what I have told you yesterday. So today we'll be learning how to take the benefit of delta neutral strategy in the low and medium volatile condition. I am going to start the event now. Scale that whenever the IV of the majority or the average IV of the options is ruling below 25%. You can say that they are in the low volatile scenario, and whenever there is means it is above 25 and below 40, it is a uh, medium, and whenever they are above 40, they are in the high volatile scenario. So that is just a general assumption about the market. So this IV of a particular option, the implied volatility of a option, though there is no direct formula to calculate implied volatility, only through computer programming only you can able to calculate it in a reciprocative way. So this IV gives you a great knowledge about the market condition. However, however, one more thing you have to be very careful about this IV. If you do not understand that IV, I can say that yes, you are saying that no, I do not understand that IV. It is quite complex for me. In that particular scenario, just understand the demand and supply. This is the very simplest way to understand any financial instrument. So when the demand is more, prices used to go up. This is a general economic term. Prices go up when demand is more, when the supply is more, prices used to fall. So this is the demand supply's nature, and this nature helps you to find out the market internal. And this option specifically is designed in such a way that we have all instrument on table before taking a call in a particular option. There is a, I have yesterday told you about the put call ratio. There is a put call priority ratio is there. The name of that ratio is put call priority ratio. What it says, call option premium added with exponential to the power of interest rate into time in year equal to put option price plus current price of the future. So this equation should be validated for a particular strike of option. I'll explain it. So if I just open up an Excel sheet and demonstrate the same thing. So call options premium added with exponential to the power of e to the power r into t. So if this particular thing we are taking, that is negative part of interest rate also, should be equal to put option price plus current price of the future. So if this equation is not equal, it is saying that it should be equal. If this is not equal, then either call option is more pricey, because if the left side of this equation is higher as compared to the right side, then you can say that call option is more pricier than the put option. If right side of the equation is higher as compared to the left side, then you can say that put option is more pricier than the call option. So demand increases the price. That thesis will come to play here. If the call options are more pricier, more costlier as compared to the put options, then you can say that the demand is lying in the call option. When the demand in the demand of call option will go more, can any journal contribute to a open interest 1? Suppose you are buying 7850 call option, someone is selling you, so open interest is 1. So though for you one trade is executed as a buyer, someone is selling for him, one trade is executed, but the net basis the open interest is 1. So if the demand of this call option goes up, what is the general understanding we can derive? Give your view. Anything you think about the market going up, demand is more, the uptrend is there, expectation of a bulls are more, so market is in uptrend. So all your views are theoretically correct. Theoretically correct. Nothing wrong in this view. Demand of a commodity is more means there is more people expecting market to go up. That's why they are buying a call option. Same time, those who are the seller of a future, they are hedging these things with respect to a call option. That also is another fact is there. Those who have already sold on specific technical level, so they are waiting the market to correct. Same time they do not want to take a risk, they just want to hedge it. That is also another factor is there. Other way also means sellers in the future segment are more nervous about that things, they are contributing that things. And Other segment of traders, those who are emerging, they are saying that okay, the demand is more, so that is contributing to more to the time value of the options. So let us take the benefit of that time value component profit. So they are forming some covered call positions into that. So all these assumptions or different trading plans are going to emerge from this. So different trading plans is going to emerge from the different trading segments. So one section of the trader forming a covered call approach, one section of trader are hedging their position, future position with this thing, anticipating this bull run may trigger a major loss. One section of traders, the call buyers, they used to thinking that okay, this is going to go up further and we should utilize this opportunity to make money. So these are the different situation has there. So once this kind of scenario you are finding out, one very interesting fact is emerging here. So though the different people's expectations are different at this particular scenario, but one very interesting phenomena is developing due to this action of call options are having a more demand is it is providing you alternative opportunity to make money, that is giving you different alternative opportunities to make money in the option strategy. This is providing you different opportunities of forming the option strategy. So that is also a very key fact on this. So this thing we have to capitalize. So let us look into this particular put call priority ratio, call option premium and interest rate, time, put option and this thing. Say this is the NSE site I have opened up here and we are near to 7,860. We have future has closed. So I am taking about that 7,900 call option and put option. 900 call option is at 67.95 and put option is so 67.95 and the 900 put option is 104.55. So here my premiums I am writing. So 67.95 and this 900 put option is 104.55. So this is the premium of 5 things we are getting. And call option, this to derive this relationship we have to interest rate in the time in year, and here also they have given a info how what interest rate they have utilized. So this is uh, 10% interest rate they are using. So we have to derive a function called exponential and rate of interest 10 divided by 100. So this is the this better if I can put it this 10 divided by 100 into a bracket. So these two also negative. So negative I need. So then I require time in year. This has to be multiplied. So the multiplication time in here. So this has been taken with reference to the last traded price which has happened on your 13th. So from 13th, how many days are left till expiry? So here calendar days you have to take. So 28th you are expiring. So here 4 days in the last week, and you have 7 here, 7 for 11, 12, 13, 14 and 15. So 15 days are left till expiry. So 15 days should be in years. So 15 divided by 365. So this is the you can get in the term of years. The time should be in year and this entire factor you should take into consideration. So you found out something here. So exponential to the power of this thing you have taken, and so call option premium and this you have to, I think here also you need the spot price. So that is so this also you require here one parameter may be missing here. So that parameter may be the future price 7860.25. So 7860.25 added with the call option premium added with the exponential to the power of minus R into T. So this is the left side of your equation. Right side of equation, what it says? Yes, one parameter is missing here. I can say that it is the future price. Future price. So this has to be added. So this has to be, future price has to be added here. So now right side of this equation says that put option price plus this thing. So put option price, this is very straightforward. So 7860.25 added with 104. So right side of equation is this one, left side of equation is this one. So call side equation is giving, this is call side, this is put side. So which one is costlier at this particular time? Call is costlier or put is costlier? Out of this thing, this put side has given you 7964.75. Call side of the equation given you 7929 point this thing. So which one is costlier? Call is costlier or put is costlier? Give your views. People having long future are buying put, number one. Number two, put is being sold for uptrend expectation. So this is also one of the things put writing is happening. Covered put options, covered put strategy is also some people are forming. And fourth, put are being bought means for downtrend expectation. So many alternatives we are going to get here, many different alternatives you can give, and many different trade plans we are expecting that it is happening in the market. So that is, many different alternatives and plans are happening in the market. This is also we are concluding. So now coming back to the low and medium volatile market. So the low and medium volatile market, whenever this kind of situation arises, put call priority ratio gives you any one option is pricier or the costlier as compared to the other option. Same time, you need to see that what is the extent of this costliness, what is the extent of this cheaperness. So whenever there is a high volatile scenario will be there. This is very important. Whenever there is a high volatile scenario will be there, the costliness or the cheaperness of this option in the put call priority terms is to vary with the band of 10 to 15%. Whenever there is a low volatility scenario will be there, the difference or the costlier and cheaperness in this particular strike options used to vary with a just band of 5% or lesser than 5%, you can say, lesser than or equal to 5%. Whenever there is a medium volatility band is there in the market, so irrespective of their temporary availability of IVs or whatever may you can say, this will be between 5 to 5 plus to less than 10. So less than 10. So the costlier or cheaperness of this call and put options, the nearest 5 strikes, if you can take a call, you can find out this particular scenario. If there is a high volatile scenario, this difference between the costliness of one option as compared to the put option compared to call, or call compared to put, will have a 10 to 15% of costliness. Is costlier to the extent what? So in this particular say, you can say that put option is having costliness. You can say here this is 30 means 34, near about some 35 rupees means difference is there. So 35, so divided by, so if we can find it out in the percentage term, so 35 So we can say that this is the difference. So 7964 minus this one. So this is the difference in the value, and the unit price is being derived from one value. So the value what we have taken it is 7860. So 7860 is the unit price from where you have found out this one, divided by 7860.25. So in the percentage terms, if you just so multiply this the same thing into 100 into 100, so you can say that it is having zero point 0.5 only zero point 0.5 is coming into present here. So this is having only zero point 0.5 difference. So the difference in the or the costliness what is there, it is very low, very low. Again means very significantly it is low in this particular scenario, and that says that you are in a low volatile territory, and that also will reflect in your IVs. So whenever such kind of low volatility scenario you will find out, you look into the IVs also. It is just 10 12, and here also some 10 14 15 it is trending nearest strikes, and average you can say that 10 12 only it is there. So this is a low volatility scenario you are finding out. Once such kind of low volatility scenario you are finding out, so now you have to form an option strategy, delta neutral option strategy. So if there is a high volatility scenario, there are two probabilities there. So this also I am just explaining in a very layman's term. If the market is in high volatility scenario, you have two probabilities. Always you will have two probabilities. Either you can fall to medium, or you maintain in that same high volatility scenario, or you can fall to low. So when you are having a low volatility scenario, that too also you have two probability. Either you can go to a medium volatile band, or you can go to a high volatility band, or you can remain in this particular low volatility band. So this, out of these three probability, any one will be there, but these are the expected probability, medium or high. So what will happen? This volatility also having a peculiar behavior along with the price. Price fall increases the volatility. Price fall, if the price is falling, then the volatility will go up, and the price is rising, the volatility will fall. So this is the peculiar nature of the volatility. So volatility is inversely proportional to the price. This is also one fact. So now we are in low volatility territory. So if the price of Nifty is falling, then we have the chances to go to medium or high. If the price of the Nifty remains same or move in the same upward trajectory things, then we'll maintain in the low volatility scenario. So this is the conclusion I have drawn. Whether you have understood this thing. Now you are in low volatility trend. If the price of the Nifty is going to fall, then you may enter to the medium or high volatility territory. If the upward trend continue in the same way, then you will be in the low volatility territory. So this is forming of net vega positive, because volatility itself is low, so there is no point in forming a vega negative strategy, net vega positive. Or you can form a net delta positive +1 to -1 based on the trend, positive or +1 or -1. This is also one strategy you can take it. So low volatility condition is there, vega is positive, post which if it is converted to a high to medium, then I will be get benefited because vega is positive. And if I will have a delta now in the low volatility scenario, +1 or -1, so post my view, if it is changing to if post my view, if it is going for a medium to low volatility, then also I'll be benefited. So for this particular two objective, what is the strategy always we prefer? The preferred strategy will be, you should have a covered put with call load, call load strategy. This is covered put with call load strategy because low volatility scenario contributes towards the price range. So what is this in detail? I'll be sell future, sell a put. So covered put is over. Then you buy multiple call to make delta plus 1, net delta plus 1. So this is the explanation of this particular strategy. Covered put with call load strategy. You can also form another one strategy, like if you are a low volatility trend now, so future short with multiple bull spread. Multiple bull spread means bull spread in the sense buying a call option and selling a call option of different strike. Future short with multiple bull spread to make net delta plus 1. This also you can form. This also you can form. So any such kind of strategy you can form because your expectation is low is going to remain low if the prices are going up, and low volatility is going to convert to a medium or high volatility band if the prices are going to correct from this particular point. So for that reason only this strategy I am forming. Logically this strategy is good. Also implementation wise, if you can say, this strategy also yields good profit in this particular situation. And definitely whenever you form this kind of strategy, your Vega will be positive only. This particular strategies always used to have a Vega positive. And one thing I have also wished to tell you, many places in many theoretical books you will find out that Vega of a future is always 0. Told Vega of a future is 0, theta also 0, only future having a delta is plus or minus 1. This also I strongly reject these things. Those who have already gone through my courses and other things, then that time I used to say that how can you say that volatility decay of a particular instrument is always 0? How can you say that instrument always having a component of volatility, and it is well exposed to the volatility. The volatility also contributes its premium and discount feature in the futures. In future contract, when it moves to premium to discount, that also contributed by its volatility. How can you say that Vega is 0? So here also, in many of my research, many of my webinars, many of my courses, I have said that Vega of a future, it should be taking as a daily volatility into account. So same way, the theta of a future is being taken as the cost of carry involved in that. What is the cost of carry involved in that? That should be the theta, because that is going to cost of carry, the premium or discount feature associated with that future contract, it is going to become 0 at the day of settlement. That's why theta should be, it has a time value. That premium and discount is contributing the time value, and that must be taken as a theta for the future. It should not be taken as a 0 at all. So that finding also with a great difficulty I have found out. When I replace these things, strategy works wonderfully. Whenever I'll take Vega as 0, theta as 0, all these things whenever I take, then the combination with future, the strategy formed with the combination of future doesn't work well. So that is, so those points also we deviate in many ways. This thing is medium volatility. So you are in a medium volatility band, so you are in a crossroad. Either you should go to a low or you should go to a high. You are in a very crossroad. You should go to a low volatility band or you should go a high volatility band, and you are also may come to this medium volatility band. So this currently you are in the medium volatility, you may continue in that. Whenever this medium volatility situation you are encountering, this is known as a crossroad. Some decision is expected which has not yet come. Post that decision, maybe price actions will be reflected. Post that decision, maybe a new volatility trend will emerge, and till that decision you may be hanging on a medium volatility band. In such kind of situations, I always prefer form a based on the trend breakout, form ratio call spread or ratio put spread, or combination of both also it can form. So wherever your trend changes are happening, so for example, if I am saying that now we are in the medium volatility of Nifty, assume we are medium volatility band of Nifty. So in this particular case, I will be saying that ratio call spread means if you are buying 7,900 call option and call option one lot, then think of selling some 8,100 call option two lots. So this is based on your trends. You can say we have calculated the trend for this week using 1SD, and we have got, this is the trend report we have got. So we are thinking that we are in the medium volatility band. So once the uptrend crossover happens, we have all probability to touch this 8062. If downtrend crossover happens, we have all probability to touch 7650 level. So in this particular situation, if you tell me, so I can say that buying a 7,900 call one lot and selling 8,100 call option two lot if uptrend breakouts gives you, and same time buying 7,000 put option, 7,800 put option one lot, put option one lot, put one lot with 7,600 put sell two lot. So this also if downtrend breakout gives. However, you have to look into the factor that 7,800, sorry, 8,100 call strike and 7,600 put strike should have highest open interest in that series. If you are selling these two options, so you must look into in a medium volatility scenario, this strikes chosen by you to form a ratio call spread or put spread must have highest open interest, so that if the price move as per the trend and goes here also, it should find out a resistance there and it should settle there, so that you should be get the maximum benefit of this particular strategy. So for that only we are thinking, because medium volatility market is a crossroad situation. So in this particular situation you have to make this thing. And one more thing you have to be very careful about forming the cross this ratio call spread or put spread, that net delta should be zero. Whenever you are finding out a medium volatility market or high, that time keeping the net delta as zero is highly appreciable. Keeping net vega as zero also highly appreciable. So these are the things, if you keep it, then those crossroad situations will not affect your trading portfolio. So this is how you should trade different products for different trade objectives. And we have many softwares also. And these futures and option concepts what you are learning, this is covered in our three different courses. One is this smart future and option course. You get the same course but different software, and this is also one course, and option strategy also. So in these three places we give you the future and option course. Only the software changes. Here you get option strategy software, here you get pair trade software, and here you get one software which is only for you utilize for the learning purpose, not for trading. So this is the different product available with us. And those who are very serious trader, they used to say that no, this is a very high time, I should learn and equip myself, then after I should do the trade. So for them also we give a very fantastic opportunity to buy all courses at a great discount of 17,500. And this is more than that. If you buy all those things separately, it costs you 47,000 every course if you are taking separate way. However, it costs you 17,500 if you take all courses together. And I can say you that in unintelligent way, if you can start trading this much more than this much amount of money, you can lose in a month. So better equip yourself, study yourself, understand the market scenario well, then you start trading. If you pause the trading for few months and study and equip yourself, that will be the best solution what you can give to your trading career. So that should be there. And it is, we are not, after selling the course also, we have not just saying that you bought a product, game is over. We always answer your queries by email. Because telephonically we cannot able to answer all queries, because these are technical things need to be understood, need to be given, the answer need to be given to you in a proper format. Henceforth, email supports we always give for the course buyers to understand the concepts. And time to time we have this kind of webinar events. Time to time we send you the recorded events. You can enhance your skills also. So this is about the full course. If you are buying, it is costing you this much. And one thing also I used to tell you here, many people have during this process, they have bought this 1SD software, and they told that how we can do intraday trade in this. Very quickly I'll just take one small presentation on this. Very quickly I'll just take it. Suppose if you are going for an option intraday trade using 1SD, you should choose this button of option here. And if you are having a smart IT software, you have a different interface for option. So here option, once you do it, then you need to calculate this thing, and once you calculate it, you will get the intraday trend levels for Nifty. So currently Nifty is at 7860. It is telling that once it move above 7810, uptrend starts. Once it fall below 7774, your downtrend starts. So based on this, you have to set a strike. If it moves above 7810, then I must buy 7800 call option, or I can sell the 7800 put option also. So you have to analyze that options at that particular time. If it is moving above 7811, then you need to buy 7800 call option, which is currently at 120 rupees, and 120 rupees it is telling. But since there is a trailing factor of, because we are in holidays, and post holidays it is going to open up. So currently it is 120, and post holidays that adjustment of this premium can give you at the 86 level. So it is saying that if it is coming, if you are buying at 7811 level, 86 rupees is the price you should purchase, and this will be your stop loss, and these are your targets. So this is, I am demonstrating on 15th, and these are the holiday, and this price what is being reflected here, it is 13th April price, that is not 15th April price. That's why you are getting this difference of 120 and 86, but in real market you get the real price. Same time, if the price fall below 77874, then you have also two choices. Either you should buy 7800 put option or 7750 put option, or you can think of selling 7800 call option. So first look into the trend. Based on the trend breakout, decide upon which strike you should enter, and whenever you calculate that strikes premium, if the premium price gives you breakout, not the future price. Once the premium price gives you a trend breakout, enter the trend, and opposite side you should put a stop loss, and these are the targets. This is how you should do the trade in the option.